Welcome back, everybody. We are now joined by our second finalist team, APM Capital. Welcome. Team, you will have 10 minutes for your presentation, after which we will move into a 20-minute Q&A with our judges. I will begin the timer when the first person starts speaking, and best of luck.
Holding $150 billion of hardworking Australians' retirement funds, Super Easy is key to securing a sustainable future. Good morning, everyone. Today, APM Capital are pleased to present our recommendation for Super Easy to become a leading super fund in both affordability and climate action. To achieve net zero, low cost, and performance outcomes, our strategy will be delivered in phases focused on alignment, acceleration, and adjustment, and is driven by three overarching levers. 1, a 2045 net zero pledge. 2, initial outsourcing of alternative investments. And 3, leveraging decarbonised core holdings.
APM Capital proposed Super Easy reach net zero by 2045, with focus on Scope 1 and 2 emissions underpinned by a governance framework connecting executive remuneration to targets. As shown on the left-hand graph, net zero by 2050 is increasingly insufficient. Current trends suggest Australia will significantly exhaust its 30-year carbon emissions budget to meet global warming targets. By 2045 net zero, Super Easy not only better support new Australian government legislation that accelerates domestic decarbonisation, but also differentiate themselves within a competitive super fund landscape. Super Easy's 2040 target is backed by peers, including the Climate Action 100 and UN Net Zero Alliance, with 60 trillion in assets under management. APM Capital's focus on Scope 1 and 2 emissions is measurable and actionable. Recent research also suggests that a 50% reduction in Scope 1 and 2 emissions across an asset class portfolio can in turn reduce Scope 3 emissions by 30%. As seen on the right, via this approach, Super Easy will become one of only 3 other Australian super funds who are fully aligned. Our management of scoped emissions is backed by a pioneering global investment collective comprised of 70 pension funds and 16 trillion in managed assets. Our net zero pledge is bolstered by linking management short and long-term incentives to decarbonisation targets. Via the top left, we can see leading global corporations are increasingly tying management compensation to emissions outcomes. Conversely, via the bottom left, we can observe that very little Asia-Pacific super funds have emissions-based incentive structures. By creating a strongly aligned management compensation framework for Super Easy, APM Capital aims to significantly enhance the deliverability of our net zero pledge, signalling the legitimacy of Super Easy's mandate to external managers and prospective clients.
Outsourcing alternative asset investment is critical to achieving low-cost decarbonisation. Private equity, infrastructure, and real estate investment outsourcing was a common trait amongst comparable ESG-focused Australian super funds, and makes sense for Super Easy until internal expertise is built up for 3 reasons. Firstly, this gives Super Easy the best chance at achieving its net zero pledge. External alternative managers have made individual decarbonisation pledges and have better knowledge of feasible emission reduction strategies, and hence Super Easy should build its knowledge through outsourcing and joint ventures in the near term. Secondly, external alternatives management allows Super Easy to maintain its low-cost value proposition. Seen on the left, hiring skilled investors and building in-house data capabilities would inflate Super Easy's overheads. This differs from public equity and fixed income assets, where publicly available data makes net zero investment strategies cheaply imitable. On the right, low-cost competitors such as UniSuper are emerging as top super funds, and hence Super Easy should not commit to initial in-house expenses without having built up a solid knowledge base through outsourcing. And thirdly, assuming Super Easy has no track record of in-house investment, underperformance risk is significant. Australian financial regulator APRA conducts annual performance reviews, which test funds' abilities to achieve their performance targets. Precedent failing products have mostly exited the industry or been merged into other funds, as seen on the left, with both scenarios presenting major costs to Super Easy's members. In an environment where compliance, member retention, and net investment performance are core concerns, as seen on the right, APM Capital recommends that Super Easy leave niche alternative investments to external specialists. For infrastructure, Australia sits on the frontier of decarbonised innovation. As shown on the left, the Australian government has estimated 40% of the future net zero pathway to be catalysed by the development of 6 core technologies. Moreover, external investment in infrastructure has numerous identifiable tailwinds, as seen on the right, including strong forecast population growth, significant levels of fiscal expenditure, and a rapid expansion in investor infrastructure interest. In private equity and real estate, Super Easy should examine managers' governance structures, including participation in the PE ESG Data Convergence Initiative, as well as operational activities, including on-site green energy production, as these two areas are critical indications of alignment in decarbonization strategy.
Our approach to core holdings begins with equities. As detailed on the left, APM Capital seeks to operate a non-exclusionary policy which focuses on creating a portfolio with holdings that have a robust net zero pathway. This rotation is crucial given the risk of exposure to stranded assets. On the top right, we can see how coal plant EBIT is rapidly compressing, and the bottom right shows how Australia is looking to bring coal assets offline. Moreover, APM Capital also recommends maintaining Super Easy's exposure to Australian equities in order to extract franking credit value from Australia's unique dividend imputation system. In terms of fixed income, APM Capital has designed a twofold strategy for carbon reduction. Here, Super Easy can capitalise on the debt opportunity, shown on the right, to invest in socially efficient projects. This means that high polluting power plants, which are not investable to equities, can through transition bonds. APM Capital, however, recommends Super Easy sets covenants such as coupon step-ups to ensure these bonds are used sociably. Our sovereign bond recommendations include the allocation of funds to top-performing ESG countries. As seen on the left-hand graph, Australian CO2 emissions underperform the OECD average, while Switzerland outperforms. The graph on the right further illustrates how this OECD outperformance is a strong trend amongst Nordic countries. Given our equity strategy is Australia-focused, APM Capital sees an opportunity for Super Easy to allocate debt into regions with similar net zero pathways to these Nordic countries, providing the simultaneous benefit of diversification and effective net zero allocation.
Feasibility is at the heart of our strategy. Our portfolio construction methodology utilized the Markowitz mean variance optimization model. Our capital market assumptions were triangulated from forward-looking data published by reputable research houses and hedge funds. Our optimizer calculated the efficient frontier that maximized the portfolio Sharpe ratio, whilst also accounting for constraints, as seen on the right, which mitigate against cash drag and over-allocation risks. APM Capital recommends a 3-stage decarbonization strategy to bolster feasibility in the pursuit of net zero. During stage 1, we rotate out of stranded assets, set our net zero pledge, and align Chief Investment Officer long-term incentives to decarbonization targets. During stage 2, we rotate out of external managers and sovereign bonds of nations without a net zero pathway, whilst we increase our allocation to transition bonds to maintain diversification. Finally, in stage 3, we rotate out of equities that do not have a quantified net zero pathway. We tilt our portfolio towards net zero alternative investments, and we adjust if needed to reach our 2045 target. Through this process, we reach our optimized portfolio in 2045, where we tilt the portfolio towards alternatives, fixed income, and decrease exposure to equities. Crucially, portfolio outcomes improve materially under our decarbonization strategy. As seen on the left, our Sharpe ratio across the period in blue significantly outperforms Super Easy's existing Sharpe ratio in the orange. On the right, we performed a Monte Carlo simulation analysis on the expected retirement balances of our membership base. Even in shock scenarios, as seen in the grey and orange, our members exceed the estimated balance required to retire comfortably in Australia. This analysis indicates that our decarbonisation strategy does not trade off member outcomes, but in fact improves risk-adjusted performance. Finally, as seen on the chart, our asset classes reach net zero by 2045 without increasing volatility, as seen in the declining red line.
APM Capital has also analysed other considerations. Now, this starts by acknowledging the stakeholder impact of Super Easy's net zero investment strategy recommendations, and across both levers, we've optimised all stakeholder considerations. The identified risks include market downturns, managerial deviation, and political instability. However, Super Easy is well placed to address them.
And so Super Easy's future is now. APM Capital's recommendation achieves net zero. It maintains Super Easy's low-cost value proposition, and it does not trade off portfolio performance. We thank you for the opportunity, and we now open the floor to questions.
Thank you, APM Capital. Excellent presentation, perfect timing. So now we will move into the Q&A, 20 minutes. Judges, please go ahead with your questions. Yes, first question comes in with Jamie. Please go right ahead.
Thank you. Great presentation, team, and congratulations on making it to the final round. I had a question on the constrained MVO, particularly on local cash rates. So great to see that you were taking a staged approach by first focusing on stranded asset risk. But I'm just curious, your overall approach, did it also account for the changes in cash rates locally, especially just given that irrespective of a transition pathway in Australia, there are physical risks to also be aware of that could have an effect on how you think about asset allocation across different asset classes and regions.
Absolutely. The question, if you could turn with me to slide 86, please. So if I could draw your attention to the bottom right, we absolutely have acknowledged increases in the cash rate domestically and globally. We recognize that sovereign bonds and yields for sovereign bonds have increased as inflation has become an issue globally. And as we can see from stage 1 to stage 2, we increased our fixed income allocation from 17% to 24%. What this also does account for as well is our recommendation to Super Easy to increase their exposure to green and transition bonds, so that we are also accommodative of our net zero pledge and our timeline to reach net zero by 2045.
All right, thank you very much, team, and thank you, Jamie, for your question. Our next question comes from Audrey. Please go right ahead.
Yeah, no, thank you. Great presentation. I guess I've got one question. There's a few different shifts that you've done in the portfolio to support your net zero pledge. One is the inclusion of transition and green bonds. I think those were in your fixed income allocation. But which asset mix shift do you think is going to have the biggest impact in achieving your net zero pledge?
Sure. Thank you for your question. So when we're thinking about our sort of investment into these transition bonds, if we can please go to Appendix 3H. So essentially what we've tried to do by investing in this area is we understand that in Australia, we've historically had quite a high polluting sort of coal areas and different things like this. However, what we aim to do with our investment into these green bonds and transition bonds is we want to be able to improve the welfare for our stakeholders as well. We want to be able to have an impact on society. So as you can see on the left, the NBN, which is the National Broadband Network in Australia, they've issued transition bonds to essentially try to create a more greener future for themselves. And by participating in something like that, we're able to enhance the welfare of our clients. Similarly, with Fortescue Metal Group on the right, which is one of Australia's largest miners, they too have issued green bonds here for green projects. And by investing in these kinds of things, we're able to optimize our portfolio to not only get returns, but also to really enhance the welfare of our stakeholders and clients.
All right, thank you very much, team, and thank you, Audrey, for that great question. Our next one comes from Paul.
Thank you very much for a great presentation, and again, congratulations for making the final. My question really was around the view that you reached that you didn't need to include things like offsets or derivatives, or I couldn't spot that when I read through your submission earlier today. So could you just give us an overview as to whether that is correct, or whether you have actually considered either of those instruments?
Absolutely. Thank you for your question. In regards to carbon offsets, I'll start with that. We believe as custodians of our members' capital that we should be allocating their capital to return generating instruments. Carbon offsets themselves don't directly generate a return, and we believe that we, as custodians of capital, should allocate our money towards fund managers who are then allocating their money towards companies that are conducting those offsets. So we do believe in a company-specific level offsetting program as opposed to that being done on a fund basis. In regards to the derivatives question, we believe that our current asset allocation mix achieves net zero and that we do that sufficiently in that manner. One thing that we do note using other financial instruments like hedges, we have assumed that Super Easy, who already had international exposure previously, would already have an effective FX hedging process to ensure that any international exposures are well hedged and mitigated against, particularly in an environment where we do have a steepened yield curve in global markets, so particularly looking at the US compared to Australia. So it's really important that that FX strategy is well implemented and well sold.
All right, thank you very much, team. I'm looking at the queue right now. Jamie, I'll let you have a follow-up question and then we'll move with Philippe. So Jamie, why don't you go ahead first?
Thank you. Just a follow-up question on the MVO, which relies on expected returns in the approach. And I'm just curious, how is the team thinking about what is the market already pricing in terms of transition risk, and how did that all portfolio construction methodology?
Absolutely. Thank you for the question. If we could please move to slide 80. So our capital market assumptions were implemented on a forward-looking basis. The reason why we did that, as opposed to looking at historical data, is due to the differing macroeconomic conditions that we are now in and entering moving forward, particularly in the Australian market. So over the last 10 years in Australia, we've seen interest rates fall and monetary policy loosen significantly in an inflationary environment that's been at an average of 1%. That's significantly changed in a post-COVID world and is forecast to continue to change. We're now seeing monetary policy tightening and a more hawkish central bank stance. So we weighted our capital market assumptions towards forward-looking assumptions, which impute these differing macroeconomic conditions, as opposed to using historical data, which doesn't account for that. And we believe these forward-looking assumptions from these reputable research houses include not only direct views on macro conditions, but also the acceleration of decarbonisation and net zero pledges across the world. So transition risks are accounted for in these expected returns and volatility. And secondly, also geopolitical risks is something we wanted to explicitly capture as well, which these reports do, and they are reflected in our numbers.
So just to clarify, you're assuming that expected returns are already pricing in transition risk, even though there's like a lack of requisite data to measure that risk today?
So our expected returns, so APM Capital recognizes that there is a lot of uncertainty in the decarbonisation process moving forward, and our capital market assumptions are illustrative in that sense. But given that there is that uncertainty, what we've done is, if you could turn with me to our Gantt appendix slide, please. So that's slide. Yep, perfect. Thank you. By taking a staged approach, what we do is we embed multiple evaluation points in between our stages. What this means is we recommend that Super Easy is constantly refining and adapting to new information and data availability, ensuring that as the world moves closer to a net zero environment, that we're able to change and ensure that Super Easy's policy, pledge, and then strategy is always up to date and refined. So although today it may be hard to price in transition risks, as you can see in the red dots here, we explicitly recommend that Super Easy should be constantly refining and reflecting upon what their framework is to reach net zero, and then how that impacts the asset allocation process.
All right, great. Thank you, team. Our next question, I'll give it to Philippe. Go ahead.
Thank you, and congratulations for great work to the team. My question is pretty simple. In your timeline, you're addressing the question of external managers only in 2027 and working with consultants during the next 5 years, while already there is in market many global investors who are taking pledges and acting on climate change. So why are you waiting 5 years, or why this timeline to address the issue with external managers? Thank you.
Thank you for the question. Happy to take the first part of that. If we can move to our timeline. Yep. So just to clarify what we mean in our stage one, when we're engaging with consultants, we're engaging with consultants to position our external managers towards net zero pathways and to ensure that we're rotating into asset managements that have committed to this. We don't want to radically overhaul the portfolio today. We think that would bear a lot of reallocation costs, which current members would bear, and future members would benefit from without bearing those costs. We aren't not acting till 2027. We are moving and building expertise and understanding where capital should be allocated. In regards to the second part of your question on why we've chosen to outsource, I'll pass it to my colleague, Gordon, to discuss that.
Thanks, Andre. So if we could move together to Appendix 2A. Our rationale behind outsourcing was threefold. So one of the main considerations was building up external expertise, which we see occurring in that 5-year period. But as my colleague mentioned, we will still be deploying capital to external managers during that time. The second rationale was regulatory pressure in the Australian market and avoiding underperformance risk. And thirdly, a highly competitive market where members can switch funds quite easily, further incentivizes Super Easy to avoid underperformance. I think the most relevant part to your question in particular will be the first one, so building up expertise. So if we could move together to Appendix 2C. We looked at Ontario Teachers' recent expansion into India, where they partnered with, they outsourced via external managers who are local to that market in private debt, private equity, infrastructure, and natural resources. And we think the key rationale behind this was really learning about investment strategies in that geography. We think this is analogous to Super Easy, and this is a process that we foresee happening in those first 5 years, where with this new investment strategy, with a net zero pledge overlaid on top of it, we think that it is prudent and in the members' best interest to outsource via external managers to build up internal expertise during that time. And over time, once they become comfortable with the investment strategy, begin bringing some of this investment in-house.
All right, thank you very much, team, and thank you, Philippe, for that question. Moving on with our Q&A, I'll give the next one to Kelly. Go ahead.
Great, thank you very much. And again, team, well done for this excellent presentation and congratulations for making the top 5. So my question really does follow on from the earlier question, again, around outsourcing. And I think it was on slide 9 from memory that you recommend outsourcing versus in-house. And I think you said there's because of the higher costs of insourcing, and again, as you just mentioned, the built-in expertise. Although there are examples of Australian super funds that have already done this and built expertise in a shorter time frame if you hire the right people, right? But my question relates to around the cost. On slide 9 again, yep, you mentioned a number of those managers there on the left-hand side. Have you considered the costs that these managers charge in terms of their fees, which tend to be high, which some tend to be higher than others? And how have you considered the costs of those fees and its impact to our low-cost value proposition? Thank you.
Certainly. Thank you for your question. If we could move together to Appendix 2B. We certainly did consider costs of both options in terms of in-house investment versus externalizing alternatives. And we arrived at the same conclusion as you. So the key takeaway was that outsourcing, we do acknowledge that outsourcing would result in higher fees paid to external managers over the long term. However, we also recognize that in-house investment requires a significant upfront cost to hire those correct staff and also build up data capabilities, particularly in alternatives, which we think Super Easy should not commit to until they've built up a solid knowledge base, which we see best achieved through outsourcing in the near term. In particular, this is a extremely significant consideration in the Australian market. If we could move to Appendix 2E. So the Australian market is quite unique compared to other markets, especially Canadian and European systems. In particular, Australian financial regulator APRA has really been cracking down on super funds' performance, scrutinizing their ability to actually achieve their performance targets. And we've seen severe consequences for underperformance as seen in Appendix 2E. Hence, given that Super Easy is pursuing this new strategy with a net zero pledge, we think it is very prudent for Super Easy to actually partner and outsource in the near term with investment managers that have really strong track records. And in addition, we also think that in the Australian market, super fund members are less sticky. It's very easy for members to withdraw their funds and go to competitors, which only doubles down on that incentive to avoid underperformance. We have considered like a transition towards in-house investment via joint ventures, which my colleague Andre will talk about.
Thank you. If we could please turn to our joint venture case studies. Yeah. So as my colleague mentioned, although in the near term we recommend ensuring outsourcing our alternatives, across our stages we want to bring that in-house. We recognize that in the long term it is a cheaper alternative. Now, the key is though building the bridge of knowledge in the near term. And what we've seen in Australia in recent years is precedence of super funds co-investing alongside infrastructure funds into opportunities. So as seen on the left, the in Australia, which involved the privatization of the largest airport in Australia, saw 3 super funds partner with 2 infrastructure funds. We recommend that Super Easy in stage 1 for the first 5 years adopts a similar approach and co-invest alongside infrastructure funds and other super funds, like you mentioned, that have brought that in-house capability, like Aware and like Australian Super. We have also made the assumption that Aware and Super, who have that in-house capability, have been doing it for a longer time. And so that there's lower risk of underperformance as they have that internal expertise. And so we do recommend that it is brought in-house, and we have recommended a strategy through which we believe they can build that internal expertise.
All right, thank you very much, team. We now have time for, I believe, one more question, and I'll give that to Vincent. So Patrick, I'll make sure that you get into the Q&A for the next presentations. But Vincent, go ahead.
Hello, team. Congratulations. Quick question for you. In terms of tracking decarbonization efforts by your external managers, how exactly are you tracking those efforts? And if a manager is falling behind some of their targets, how do you make decisions regarding this?
Yeah, so if we could turn together to Appendix 2G. One of the criteria that we had in selecting external managers was to look at managers who have explicit decarbonisation pathways and who have likely made some sort of decarbonisation pledge. So we've sort of looked at 3 case studies here in terms of profiles for these managers. So Adam Capital in private equity, Macquarie's Green Investment Group in infrastructure, and Dexus Group in real estate all have very explicit asset-specific net zero pledges. We think that with these pledges, they are best positioned to have the data capabilities and the processes to actually measure emissions in their asset category. In terms of measuring or tracking or funds potentially falling behind, that's built into our incentive structure, which I believe my colleague Dominic can talk about.
Yeah, absolutely. I'll discuss the management incentives. Part of our net zero pledge is to impart incentives into the structure, and we use it to improve the execution and feasibility of the net zero pledge, grounded in the central tenet that incentives drive performance and reduce greenwashing risk. So looking to this slide here, we've split the incentives into 2 arms. Firstly, the asset manager level, which is part of our external investment strategy. And then for our management, Super Easy CIO and Super Easy C-suite executives, that's the internal level of incentives. And just in the interest of your question, I'll focus on the asset manager incentives on the left-hand side. APM Capital recommend that Super Easy impart an asset allocation focused incentive, which means on a go-forward basis, we don't want to be exposed to any funds without a quantifiable net zero pathway. And what this might mean is A, having clear steps toward decarbonisation, but B, also having independent recognition of net zero and decarbonisation efforts that we believe gives us the best opportunity through external investments and outsourcing of achieving net zero by 2045.
All right, thank you very much, team. That wraps up our Q&A quite nicely. Thank you again for your wonderful presentation and for our judges for your amazing questions. We will now be taking a momentary break before we welcome on our third team, Terra Capital. So see you all very soon.